Is the Fed about to burst the housing bubble? Are investors taking the phrase, "don't fight the Fed," a bit too far? And with the payroll report coming on Friday, is the bond market signaling there's a major risk-off event coming that the market can't see? Answer those questions and more on today's Macro Show. I'm your host, Steven Van Metre, and thanks for joining me today. And yes, I'm well aware I'm wearing the shirt some of you love, some of you hate. And there's also rumors that possibly Wednesday, the kingdom will have a new look. Many of you have asked for this for a long time. Maybe it'll happen. So let's talk about the headline story is the Fed actually going to pop the housing bubble? Well, we're hearing a lot of rumors from the large commercial banks saying tapering is coming, the Fed's going to do this, and they're going after those mortgage bonds sooner than you think. And everyone believes that those mortgage bonds are what's driving housing prices higher. Let's go to the Wall Street Journal and take a look at the article today. Fed officials debate scaling back mortgage bond purchases at a faster clip. Well, it's interesting because they haven't started rolling anything off yet, so this is a bit ahead of us things. And soaring home prices lead some officials to call for the central bank to stop buying mortgage bonds sooner than treasury bonds. Now, there is some truth to that because we do know the Fed did talk about that at their last meeting. And this is being blown up to believe that this is coming sooner than everyone thinks. Fed officials at their June 15th to 16th policy meeting reaffirmed plans to continue holding short-term interest rates near zero and to continue the asset purchases for some time. Of course, according to Jay Powell, the Fed chair, we know that this also involves bringing the unemployment rate down significantly. They also began discussing when and how to begin reducing or tapering asset purchase as an initial step toward weaning the economy off of such support, to which I will question their ability to actually do that. And according to Dallas Fed President Robert Kaplan, there are some unintended consequences and side effects of these purchases that we are seeing play out. He said in an interview referring to the mortgage bond purchases, which he thinks are contributing to skyrocketing home prices. That's right, even the Fed thinks that higher home prices have to do with their own policies, has nothing to do with a whole lot of people going out and buying homes simultaneously and evaporating the supply of homes on the market. Nope, nothing, had nothing to do with that. Had nothing to do with the pandemic causing builders to slow down or stop building for a period of time, bringing a lack of new inventory to the market. No, had nothing to do with that. It's nothing to do with anything except monetary policy. And that's baffling because we can even look at the credit market and start to think that the Fed's not even going to get a chance at this taper. And here's why. Here's from the credit data from last Friday. We look at real estate loan growth in blue, 30-year fixed rate mortgages yields in red. And what do you see when there's a contraction? You see the blue under the black line here. When there's a contraction, what happens to interest rates? They go down because demand for housing goes away. And then you have a housing crisis because there aren't enough people to buy homes to support higher prices. And that's what a contraction in lending does. It says interest rates are going down. So perhaps the issue here isn't that the Fed causes asset inflation. The real truth is perhaps it's a supply and demand issue that's about to go away. And you could see contraction here, rates go down, contraction here, rates are headed back down. And it's all telling you that perhaps the real reason this is all going on is rates were low. There was a huge demand for housing and there wasn't enough supply. And of course, we know that that will eventually be fixed because there isn't an infinite supply of anything that the market can't bear. And there has to be enough demand to persist these higher prices. And if you watch the Friday Macro Show, do you remember what home buying conditions were? Yeah, multi-decade lows. In fact, you had to go back to before the 1980s to find out where potential home buyers had less demand for buying homes than they do now. So the market's already saying, look, this is a bubble. Everyone that's wanted to go buy a home did. Those that could afford did. Those that can't are priced out and are forced to wait. And as it turns out, those that are priced out are slowly going to become the majority as all the buyers start to evaporate. And it's not the Fed's policy that's going to change this, it's the market, because there's a supply and demand for interest rates. When interest rates are going down, they go down to find supply of borrowers. It's a supply and demand issue. When rates are rising, what does that tell you? It tells you there are lots of people wanting to borrow and not enough money to lend, so it drives rates up. So we're seeing rates go down, and of course that tells us eventually the financial conditions are going to tighten. But let's continue the story a little bit, because it's not just real estate loans that are in contraction. It's commercial and industrial loans. Growth rates down to minus 15% from a year ago. So you're seeing contraction across the broad lending space. Loans and leases, all loans and leases, commercial banks in contraction at minus 3.34%. You don't see these contractions occur during inflationary periods because money is destroyed. And I think the issue is you couldn't see those charts. So let's go back. You see commercial industrial lending here, and you see loans and leases here, contraction, and even credit card data contracting. And all that's telling you is there isn't enough demand to keep rates up. And since new money is created when people borrow, which is really important, and money is destroyed in contractions, that eventually there's not enough money or buyers to keep these higher prices up. Let's go back to that article, because they mention up here somewhere, they begin discussing, in this dot plots, and the Fed pencils in earlier than interest rate increases. Now, most officials now expect to raise rates by the end of 2023. And is that true? Is there any truth? And of course, Jay Powell scowling at us saying, probably not. But let's just look at the facts, because that's really what matters. The evidence of transitory from prior inflation hiccups. How about this? From September 1989 to November 1990, inflation spiked from 4.3% to 6.3%. Did the Fed do anything? No. How about January 2002 to March 2003? The inflation rate went from 1.1 to 3.0. Hey, the Fed was cutting rates. They didn't tighten, they cut. How about October 2006 to July 2008? The inflation rate soared from 1.3 to 5.6. Fed didn't tighten then either. And then last but not least, during the early recovery from June 2010 to September 2011, the inflation rate went from 1.1 to 3.9. Can you imagine that? And how many years later? Do you know how many years later? Guess. I'll say 1, 2, 3, 4, 5, 6. How many years later did the Fed start tightening? Ready? 4. 4 years. And now here we are with everyone talking about how the Fed's going to start tapering their mortgage purchases at the end of this year. Well, how about this? Transitory in the Fed speak is 1 to 2 years. So odds are, from what we're hearing from Jay Powell, he is right. The Fed isn't likely to taper anytime soon because of their dual mandate. One of those being low unemployment. So they've got to see people get back to work, because that's what they believe causes inflation. So is there any chance of the Fed tightening? It's pretty low. In fact, we can even go to the Atlanta Fed, and their wage growth tracker is rolling over and headed lower. Now, on a year-over-year rate, it's still growing at 3%, which is a very attractive number. But if you can consider this, actually, this is a 3-month moving average of median wage growth. But anyways, nevertheless, do you think if wage growth is trending lower that you're going to get inflation? No, you need wage growth to go higher, because how do higher prices get substantiated? By people being able to afford them. So you need higher wages to afford higher prices, and then with that, it makes perfect sense. But with the Fed keeping their foot on the monetary gas pedal here, it tells investors, hey, don't fight the Fed. And maybe because of that, they're getting over leveraged. Let's take a look at margin debt, which has gone off the charts. And you can see here this from Advisor Perspectives. And in blue is the S&P 500. And here's margin debt. Now, what this means is people are opening accounts, putting money in those accounts, and then taking a loan against it to buy stocks. And what happens as margin goes higher, this is really important, the amount of money they can borrow goes up. So if stocks go up, where's my up arrow? If stocks go up, then the amount of money people can borrow goes up. So what do? They invest more money, they borrow more money, and they buy more stocks. And it creates a self-feeding feedback loop. Now, why is this trend dangerous? And why does don't fight the Fed mean this is no big deal? Well, if you are buying on margin, you might not be too worried, because the real fear is when the Fed starts to raise rates. And when the Fed starts to raise rates, guess what your cost of your margin debt does? Well, it goes up and causes things to get tight. And then all of a sudden the bubble bursts. So what investors perceive right now is these low rates, these artificially subsidized low rates by the Fed, mean take maximum risk. In fact, maybe borrow on margin and then buy some leverage stuff while you're at it, because there's no fear. Investors have no fear the financial conditions are tightening. And yet, when you start to look at the bond market, well, it starts to tell you something else is going on, because even if you're just an equity-only investor, you really ought to pay attention to the bond market, because there's two things going on in the bond market right now. Bonds and the dollar are telling you financial conditions are starting to tighten. And see, investors, particularly a lot of young investors who are the big drivers of margin debt right now, they don't understand the quantitative easing inadvertently tightens financial conditions at the same time it lowers rates. They don't understand that. And as a result, they don't understand that falling interest rates eventually means falling stock prices. So let's take a look. So as investors continue to not fight the Fed, all they're doing is bidding each other up higher. And if there's a big risk off event, well, there's going to be a lot of selling, because the way it worked, and as you can see here going into March, why did all this margin debt get wiped out so quickly? It's because computers now decide for you what you're going to sell when you get the margin call. And so it just starts a rapid selling event. Well, if financial conditions are tightening and people are over levered, well, you can only imagine what's going to happen. But let's take a look at the bond market, because maybe it's telling us something that the equity market can't see. Now, many of you have asked me to go over this concept, and it's been a while since we visited, but I've got the 3-month Treasury bill, T-bill, against the Wilshire 5000 price index, and I meant to turn off these tooltips because they get in the way, so let's go do that. And one thing that people tend not to understand is that when interest rates go down, it tells you that financial conditions are tightening, and that usually means there's a peak in the market. In fact, interest rates tend to peak on average 3 months before equity prices. You can see here they both went down. And this starts to make sense of why do equity prices tend to like higher interest rates? Well, because what is it telling you about the economy? It's reflating. It's expanding. See, in a debt-based economy, as the debt expands, the economy expands. That's why there's all this push to get people to borrow and spend, borrow and spend, borrow and spend, get more and more and more in debt, because it creates money. So when interest rates go down, money is destroyed quicker as people pay back their loans at a lower interest rate. Think of it. If you had a 0% loan and you had a 10% loan, when you make a monthly payment on the 0% loan, it's all the principal. Money is destroyed. At a 10% loan, well, you've got an interest component that has to get paid, and that money stays in the system. So as the lower rates go, the more money is gone to principal on a regular payment, and that tightens financial conditions because it destroys money. But let's look at this even further, because you can see this relationship here going to the great financial crisis. 3-month yields crash, stock prices crash. And then you see here going into the pandemic, yields were front running it down. They crashed, stocks crash. But this time, everyone thinks that this was the bottom of the market. They think this is the beginning of bull market here. They think this is a beginning, that they thought, okay, this is the beginning of bull market, and then down here was the beginning of the bull market. So investors say, this is the beginning of the bull market, so I'm going to leverage myself like crazy. And you can see that relationship even with 10-year Treasury yields against the Wilshire 5000. And I guess my intention to turn off tooltips completely failed on these two. Hopefully I did it on the third one, but let's take a look at this chart, and we see the same thing, that yields start to peak here ahead of time. And what are they telling you? Financial conditions are tightening up, and then stock prices go down. Here you see yields peak, stock prices peaked a little bit later, tells you financial conditions are tightening. So why perhaps in here this didn't really happen? You can see yields coming down, stocks came down a bit in here, is again, there's a supply and demand component. Sometimes interest rates go down just to pick up supply. So you have to put yourself in the role of a banker, right? You've got money and you're going to lend out, and you put an ad out that says, I got 5% money. I'll lend anybody for any reason 5% money, and no one shows up. Not one credit application. Now, are rates too high? Wrong arrow. Are rates too high or rates too low if no one wants to borrow your money at a given rate? Yeah, they're too high. So that's why rates come down. If it comes down, it spurs lending growth, which is why we looked at those lending charts a little bit ago. It tells you that rates aren't low enough to spur lending growth. Or Maybe they are. The problem is money is being destroyed too quickly because we're at effectively zero interest rates. Remember, I've talked about the curse of ZIRP, of curse of 0% interest rate policy. It's dangerous. When central banks get trapped at zero, there's no way out of the deflationary spiral that's to come. So let's continue looking at this, because what else is the bond market telling you is it's rolling back over now. And we're in the middle of still in a recession, and investors think this is the bottom of the bull market, and this might be the biggest bull trap in history, because what they don't understand is the relationship the treasury yields and the dollar have. And when you start getting these two paired together, you've got a lot of trouble, because let's pause that for a second and say, what is a treasury bond? It's a form of deferred dollars, right? You put money in a bond and you get it back at some period of time in the future, whether it's a short-term bill or a midterm note or long-term bond. And what is the bond pricing in between the time you buy it and maturity? If the value of those dollars are going up or down. And if the values of those dollars are going to go up, then the value of your bond's going to go up. The value of the dollar is going to go down. The value of your bond's going to go down, and that's going to be reflected in the interest rate. So when you start to see the two combine and go in the same direction, because they are effectively very similar, one's just a deferred version of the other, then you know financial conditions are tightening. So let's take a look at this, and here you can see in the great financial crisis that I'm showing the dollar inverted here. So the dollar's falling, and now the dollar starts to rise, interest rates start to fall, boom, there goes your equity bubble, bye-bye. And so here you see interest rates going down in 2015 into 2016, and here you see the dollar rising. Remember what happened in 2016? Yeah, the financial conditions tightened up. There was a bit of a move down in the equity market, and we almost had a recession. And now what's happening here is you see interest rates go down and the dollar starting to go up. And that's telling you financial conditions are starting to tighten again. And it really makes a whole lot of sense, because you think about the economy, and with people going off all the unemployment benefits and the stimulus checks being done, there isn't a lot to hold it back up. And then you start to look at, well, what are those hedge fund managers up to? Because they play a role in this too. Because when you think about what a hedge fund manager or investor is trying to do, they're trying to front run an event. That's what they're in profit on. So if you know there's lending growth, then what is the next likely conclusion? Well, the interest rates are going to go up. That's what you're going to assume. So if you wanted to bet on that, well, you're going to short the bond market, and you're going to short it in a big way, especially if you think, which is not correct, that there's money printing going on, because, well, that would have to drive interest rates up. We know that from history. So one of the key things about looking at how hedge fund managers are positioned is because what they do is they short the bond market to drive interest rates up with the intention of buying those bonds back at a lower price, and they take the proceeds from those bonds that they sell and they buy stocks with them. And so you start to wonder is, why does that relationship between stocks and yields exist together? Because people short the bond market, and rising yields as demand is there tells you there's reflation. By the same idea, there's a reason why lower interest rates eventually mean lower stock prices, because it tells you financial conditions are tightening. And that's why I'm interested in what's going on with these hedge fund managers and other speculators. And you can see right now, in terms of the 10-year, they are, switched to net short. So they went back shorting the 10-year. And on the 30-year, now they're still about where they were. So they're still equally net short. And it's not until you see the 10-year speculators way up here in a long position, and on the 30-year way up here, where they're on the wrong side of the fence. And the reason is because they get squeezed out of their position and are forced to buy bonds. And they're forced to buy them potentially at a higher price. And how do they get the money to buy them? They got to sell their stocks. Does it start to make sense? So let's take a look at the dollar position, because the dollar from the speculative position, let's see where it's at, also gives us an indication of where they're at. And you see that they completely cut down their long positions and are pretty much even. So they backed off all their positions, and you see here index futures down 78%. So they are not long at all. They're slightly net short. So it's telling you that speculators are mispositioned, when you really start to realize that the dollar is headed higher and treasuries are headed lower, it's telling you financial conditions are tightening. It's telling you the reign of the bond kingdom is not dead. It's coming back in a big way. And that's why hopefully on Wednesday, we'll see some new digs. Anyways, I'm Steve Van Metre. Thanks for watching. You appreciate you being fans, subscribing, liking the show. Just, you're awesome. If it wasn't for you, we wouldn't be here. So thank you, and we'll see you back on Wednesday for the Macro Show. Again, I'm Steve Van Metre. Bye now. The content of this video provides educational information only and not intended to provide investment or other advice. Shows not to be construed as a recommendation or solicitation to buy or sell a security, financial instrument, or participate in a particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.